Well, Glenn Stevens is going to be appearing before a Senate committee tomorrow, and he will be quizzed about the board's monetary position, and the markets are really likely to hang off every word, as we always do. And of course, one man who'll be very closely watching it is Jim Stening. He's from FIIG Securities, and we hang off his every word too, of course. Jim, thank you very much for your time. We've got this testimony tomorrow. Is he going to shed much light, any extra light on monetary thinking or the board's thinking?
Well, we sort of expect it to be consistent with the recent press releases coming out of the RBA. I think if you look at the minutes from the last meeting, you know, there was it sort of goes to great pains to explain the decision that to keep rates where they are. I think throughout that document, and what we expect tomorrow is for him to sort of reiterate that the direction of rates is up. In that document, in the minutes, they actually go to great pains to reveal that in their modelling they're building in increases in interest rates through the year. So I would expect he to be very consistent with those comments. And
therefore, is it going to be a market-moving event or just something of interest for us?
Well, I guess you know, it's all about transparency. So in theory, this information that he brings should be well in the market now. But you know, I mean, I think there are some interesting things developing globally. There may be some views that have changed within the Reserve Banks, you know, given the Greece situation or given recent developments in markets. So if there is a divergence, or if we start to see him extrapolating on those things, I think possibly there could be some movement, but generally no surprises.
I suppose Greece is probably the issue that's cropped up since the RBA meeting. Well, I mean, it was kind of unfolding, but we've gotten more clarity, I suppose, on that situation since the meeting was had and those minutes were written.
Yeah, that's right. I think, you know, we've had the benefit of a couple of weeks, and there's certainly been a lot of talk about it, a lot of concern about it. But markets generally, you know, indices all over the world seem to have swallowed that information.
Yeah. There has been concern for weeks, and it's been holding back the markets, that this Greece situation might spread. Is there actually any evidence of that?
Well, I mean, that's certainly the momentum in the market that was building. I think that you know, there's an argument that it may be contained within these smaller economies in Europe. But I think as far as Australia goes, one of the things that I think it highlights is how secure this an investment in, say, our sovereign debt is in comparison. So, in a way, it's a sort of a plus for our bond market. Yeah,
we actually just spoke to JP Morgan's Sally Old before as well, and she was saying this is something you get the feeling of, that, you know, we're in the kind of the top three. If people or investors are looking around for somewhere to put money, where do you want to invest in terms of bonds? Australia's really up there right now.
Absolutely, no question. It's a really impressive proposition for global investors. And what's happened globally, a lot of these investors, they're spending a lot of time analysing the sovereigns, and importantly, you know, obviously they're spending a lot of time on the PIIGs. But what an analysis of the sovereigns in terms of relative value, what that will reveal is how outstanding Australia is.
So do you think, and again I said this to Sally, do you think Australia is registering there amongst global investors, big money managers, because we're still a small market and we like to think that people are noticing us, but sometimes when you chat to US guests, they're still so US centric, you know?
Well, that's very true, but people are looking for alternatives.
And you're getting that kind of feedback even?
I think so. I think there's a really good argument to look at Australian bonds. One of the issues confronting the salesman, I suppose, is that we haven't been issuers of bonds for a long time. It's only in the last 12 months that we've actually, you know, started the printing press. So I suppose there's a little bit of work to be done. Probably a few roadshows for the AOFM and for the state governments as well to really get the message across fundamentally to those buyers.
Where are the big markets then?
Oh, the big markets are Europe and Northern America.
North America, of course. Okay, so let's all ask you about the US economy as well. We've talked about this Greece issue, but the other issue that, and we mentioned it with a couple of US guests the last few days, China selling US treasuries, and I think Japan's now the top of the list in terms of holdings. Is that significant? I mean, they've been selling for about 5 months.
Yeah, I mean, I suppose you know, looking at the numbers, I don't think they're hugely significant. I think you know, obviously when someone sells, someone has to buy. It's a zero-sum game. But if the trend continues over a long period of time, well, then that could cause problems in terms of the price of treasuries or where they have to issue them.
You doubt that those new buyers will come through? I mean,
well, there will be replacement buyers, but I suppose if that's the case, then there may be a case for them to demand a lower price to purchase treasuries, so yields would need to move higher.
Are we expecting any sort of crisis in the bond market this year?
I don't think so. I don't think so. I mean,
extreme,
obviously, there's a huge program. There's a lot of issuance that needs to take place in the US, and the problem that the US economy has is that it needs to be stimulated. It's difficult because in order to stimulate, you need to sell more bonds. You need to, and so it's sort of a vicious circle. We need to see a recovery in the US before that matter's complicated. And it's interesting. I mean, we're starting to see talk at the Fed about how they're going to start unwinding stimulus, or how they're going to start selling the bonds that they've purchased, and how they're going to be, how they will, what in the FOMC minutes last night, talk of how the initial stages of tightening will involve a discount rate increase before an official increase and those sorts of things. So it's being mapped out for us. It's going to be interesting to see how it plays out, because obviously a lot of the borrowers in the US economy are fixed rate borrowers, and those long-term rates are very high. And one of the reasons why they bought long-term bonds was to keep those benchmark rates low. So if they join the throngs of sellers, it could get a little problematic.
Okay, and I think one of the other messages from the Fed minutes seemed to be that the downside risks are kind of diminishing in the Fed's eyes anyway. But what about the financial institutions? You've been looking at this issue a little bit in the second tier.
Yeah, there's fundamentally an issue with sort of the regional banks in the US, and they're not out of the woods yet. A lot of them have exposures to commercial-backed mortgages and things like that. So those default rates in those types of loans are still increasing. So that's something that needs to be watched.
And can I ask you as well, this week we're due to get comments from ASIC in terms of a review of the bond market here in Australia. How important do you feel is this review?
Well, I think it's very important. Yeah. I think it's fundamental. I think it's responses to consultation paper 126 that are due back tomorrow, I believe. Yeah. So yeah, I think it's a very important step. I think what would be disappointing is if it didn't actually allow what it's intended to do, and that is to create a retail bond market so that you've got easy access for investors and easy access for issuers. Okay, and you'll be making a submission? We have. Yeah. Okay. Along those lines. Yes, yeah. I imagine. Okay, good. Jim, great to have you on board again. Thank you. And we whipped through it all today. Last time we got you on, I didn't manage to get through it all. So thank you very much. Thank you, Jim Stening there from